Good afternoon, folks. It's David Burrows, Chief Investment Strategist and President here at Barometer Capital Management, and I want to welcome you to another Wednesday Barometer Readings webcast. Today, I'm going to spend a little bit of time talking about markets and market conditions and some of the changes we've seen recently. And I'm also going to welcome Jeanette Lowe, who is a Director of Policy Research at Strategas Securities. She is going to spend a little bit of time talking about potential impact on the election and what investors might be looking at as far as takeaways as to what they might be thinking about going into the election and post the election, because of course this is something that we have watched people obsess over the 4-year election cycle, and we're now very close to getting underway. So just before we do that, I want to talk a little bit about markets. Through our lens, as you know, we're trying to do 3 basic things. We use the tools and the process that we follow to try to identify market leadership and target assets and asset classes that are going through positive revaluation, where something's changing for the better, and where either multiples can expand or spreads can compress in credit. We're trying to just target those areas of the market that really have a tailwind. We're not trying to be everywhere. We use the tools that we have every day and the process that we go through to try and recognize change early. That's where the name Barometer came from. Try and recognize things before it's obvious. And then there are those times when nothing's working, when risks are high, and we may choose to have a significant cash weight or avoid certain parts of the market. And we have a whole discipline around the capital protection piece, which includes, of course, stop losses and using the breadth-based models that we have to try and step away from groups in the market that have a headwind, because in the end, it's no fun to fight the tape. So this is a very tactical approach. There's lots of great approaches to investing. This is one that tends to complement other strategies well because it has a low correlation. Now, many of you have heard that over the last number of years, we believe we are in a structural or secular bull market that really kicked off as we took out the 2000 highs in 2013. And when we look at equity markets long-term, structural bull markets tend to go on for a long time, 15 or 18 years. There are big interruptions that come along during the piece. There are cyclical bear markets along the way, but it tends to be more like 3 steps forward, 1 step back. Quite different than what you might see in a structural bear market, where it's almost like 1 step forward, 1 step back, cyclical advances and declines, but the market doesn't make much progress. When we look at the individual markets, of course, that we cover, we spent a lot of time in U.S. equities over the last number of years. Market took off in 2013 after really making no progress since 2000. And despite, a tough market in 15-16 and a tough market going through 2018 into 19, and this most recent sell-off in February and March, markets continue to be in this channel and work their way higher. NASDAQ, of course, has led and is sitting right at the very top end of its channel that it's been in for quite some time. But really, we didn't take out the 2000 highs until 2000. So that might suggest this market could move higher for some period of time in front of us. But we do believe that the long-term structural backdrop for equities is a positive one, and that this is a place that will generate sort of above average returns going forward with interruptions, and we're always watching for those. We know that this market has been significantly positively impacted by liquidity. And when we go back over time, when we see these bursts of growth in the monetary aggregates, it has tended to come at periods of stress, and it has tended to help offset those stresses. And in this case, the combination of monetary policy and fiscal policy has really had a positive impact. And I think that most people would agree market price action has been much better than people would have expected given the environment that we've been going through. When we look at the S&P off the lows in March, we had the first major move, which was driven really technically and by stimulus. We had a bout of profit taking in the beginning of June. We've had advances in therapeutics and vaccines and additional stimulus that's come through the course into the beginning of September, where we began a correction. And as of last week, when we talked on Thursday, we said it looks as though some of our short-term indicators are resolving more positively, and we took out this resistance and Thursday, Friday, Monday had good days. Market pulled back a little bit at the beginning of this week, Tuesday and Wednesday today. But in general, things look as though they are improving. Same for the NASDAQ. NASDAQ last week when we spoke was in this little wedge consolidation, trying to get above this high from early September. And we've done that. We tend to come quite sharply out of a wedge to the upside or to the downside, whichever direction we go. It turns out we came to the upside, a big day on Monday, a big gap left behind, and market has consolidated over the last 2 days. Not impossible. You could see the market pull back and fill this gap. It often happens, but in general, since last week, the indicators have gotten consistently better. Now, the lenses that we look through, as you know, are very much about understanding what is happening as opposed to what we think should happen. 3 basic pieces to the strategy. We are constantly running a bottom-up screening process to try to identify securities within our investable universe that are good getting better. Okay, I want to say that again, good getting better. We will never try to buy things that are broken, hoping that they get fixed. We think that the risks are very high in those circumstances. When you want to find things that can see multiple expansion, we want to see based in the numbers, things are improving, if not accelerating, and that price is doing what you would expect it to be doing given those set of factors. So we want to see strong fundamental characteristics, strong technical characteristics, and that drills down to a smaller universe of stocks that meet those tests, and then we have a due diligence process to go through to try to figure out which of those we might like to own. Now, they still don't wind up in a portfolio until we figure out if they are in parts of the market that we care about. And so the second major part of our process is understanding market conditions. And as you know, we run breadth-based models to try and identify parts of our investable universe that are seeing net inflows of capital. Where is money getting put to work today? What is it that has a tailwind? And those areas of market leadership could be sectors, they could be themes, they could be geographic regions, they could be specific investment styles, or they could be specific market caps, size of companies. But where we can find pockets within our investable universe that are seeing net new money get put to work, breadth is expanding, and we can find securities within those groups that meet our business tests, well, that's where our portfolio lives. And then, of course, the last and most important piece is that we run stops on everything because we believe that having a really disciplined selling strategy is probably the most important part of investing, because you can't ever afford to let a little mistake turn into a big mistake. So we trail our positions with stop losses, which lets us stay in our winning positions as long as they work. And when they stop working, they come out of the portfolio quickly and quietly, because there are thousands of securities we could choose from at any given time. We need 20 to 40 to make a portfolio. We want to have all of these things lined up. So let's talk about that a little bit. Where is it that we are seeing expansion in breadth? And which areas have we been a little bit more cautious about where there has been deterioration? So let's go back over the last week. When we came into last week, breadth globally had been contracting. We had gone from 60% of stocks globally in uptrends to, by the end of September, only 42% of stocks in uptrends. In this past week, breadth has reversed for global markets. So we now have expanding breadth for equities globally. In the US, again, we saw deterioration in breadth through September. We went from 66% of stocks in uptrends to 46, or 20% of stocks gave point and figure sell signals, meaning fewer stocks had a tailwind. And in the past week, this breadth reading has reversed higher. So we have the ball, right? The offense is on the field. We have a wind at our back in US equities, global equities overall. European equities just recently turned positive from a breadth perspective. We've seen some improvement in Asian breadth. Latin America is still lagging. Whereas all of our various breadth indicators were weakening 2 weeks ago, we had some positive short-term indicators a week ago. Virtually all of our indicators have turned positive today. So that's not to say that there is no risk. There's always risk. We're headed into an election. We are in October, which is the most difficult period seasonally. But having said that, we've had things to worry about all year long, and none of these things are new. We do have very significant monetary and fiscal stimulus in the system. We have other positives by way of new data on therapeutics and vaccine to look at. There is potentially additional stimulus to come, whether it's before or after the election. But the backdrop at this point is one that is resilient. When breadth is expanding, whether in our short-term indicators or our long-term indicators, it means the market has a shock absorber. It means that news can come and will likely be fairly favorably absorbed. And you've seen some quite difficult news, especially around the potential fiscal stimulus that has been slow in coming, but the market has been able to absorb it. It tells us we're on a fairly solid footing. Things that have happened over the last week. We've seen an expansion in areas of leadership. Materials have behaved really effectively over the last 2.5 weeks against a fairly sloppy market. Now that includes chemicals, it includes base metals. The golds were correcting a little bit. They are showing a little bit more strength in the last couple of days, but these are economically sensitive stocks. The industrials have had a good couple of weeks and on a relative basis, gaining strength versus the market. And that includes companies like Deere and Caterpillar. It includes some of the automation companies. Certainly, we showed the robotics ETF a couple of weeks ago. It's really outperforming and making new highs relative and absolute versus the market. We have the Russell 2000, which had been a real laggard, is making a move versus the market. And we pulled back a little bit in the last couple of days, but certainly, this has been an area of strength that has been additive because this group had been lagging. Another change that we've seen is from a breadth perspective, fixed income has given us a sell signal. We talked over the last couple of weeks about this consolidation the long end of the US bond market had been in, and the fact that it broke down last week. And that has implications. Certainly the high dividend camp, which would be an area that we might focus in our income strategy, has really been underperforming year to date. When we look at the high dividend ETF, which is really full of bond proxies, utilities, telcos, REITs, staples, still down 22% from the high. And we compare that to dividend growth, which has been much better. The dividend growth ETF down 6% year to date. Still nothing like the S&P because, of course, it doesn't have the very large growth stocks in it. But this is representative of where we've been focusing in our tactical income strategy. So these, I think, are watershed issues because materials, industrials, dividend growth all do well in a reflationary environment. We've been in a disinflationary environment. Reflationary environment's good for stocks as well. So these are all, I think, positives. When we look at what's been going on around the world, the Russell 1000 growth index, or the QQQ, which is another proxy on large cap growth, has been very, very strong year to date. S&P is positive. When we look at emerging markets, slightly negative. EFI down about 7%, Russell 2000 down about 8%, Russell 1000 value really underperforming, although better over the last couple of weeks. From a sector perspective, real broad diversity between the groups and dispersion. We've talked about being targeted all year long and things like technology, both semiconductors and software, consumer discretionary, some areas of healthcare. That has been where the leadership has been, but we are seeing some broadening. TSX continues to be challenged. Our local market's still down about 8% from the high. So still relatively underperforming pretty significantly, US stock market. And so we still have to really pick our spots. Now we have lots of folks calling us, wanting to talk about different things they have concerns about. And the biggest issue is the pandemic. We've talked a lot about that, issues that surround the pandemic, industries that have been impacted, industries that have been helped, and industries that have been hurt. But we've been getting a lot of questions about the potential impact of a US election, which is now less than a month away. So today, I'm very happy to have with us Jeanette Lowe, who is going to join us and talk a little bit about the election and some of the impacts that we might see. And I'm really, really pleased to have her with us. Just to give you a little bit of a background, Jeanette Lowe is a director of policy research at Strategas Partners. In her capacity, Ms. Lowe directs the firm's public policy research efforts and translates the impact of these policies may have on financial markets. The policy research team at Strategas has been recognized as one of the top policy research teams in Wall Street by Institutional Investor for 11 consecutive years. So Jeanette, welcome and thanks very much for joining us today.
Thank you, David. I appreciate it. And thank you for inviting us to join the call. Obviously, the outlook for the 2020 U.S. election has changed pretty dramatically from where we were at the beginning of this year with the coronavirus pandemic and then the pandemic-induced recession and then just regular social unrest that has been cropping up across multiple cities and areas in the United States this year. Trump's odds of re-election have been thrown into flux. And it could be that this election actually becomes a referendum on Trump's handling of the coronavirus. So I'm going to touch just a little bit on the current state of play of the election, but I wanted to focus initially on what the market is likely to expect from the outcome of the election and what are the policy priorities and what does that mean for stocks and sectors from both President Trump and Vice President Biden. So these are three main electoral outcomes that could happen here. So we have one that is just a status quo election. A second would be the Democrats sweep and take over the White House, the House, and the Senate. Or we could see Joe Biden winning the presidency, but the Republicans maintaining control of the Senate. And all those would have different implications for policies that can be enacted. So markets prefer consistency from elections. If we were to have a status quo election, which means that Trump would win re-election and the House and Senate would stay in the divided control that they currently have, that means that we would expect the market to actually move higher over the course of the year. We've generally seen, as you can see from this chart, if the incumbent party has won over the next 12 months, we've tended to see higher equity market returns than in the case when the incumbent party has lost due to that greater market certainty from what's coming out of Washington. If Biden were to win the presidency and you have Democrats sweeping the election, we would expect lower market returns, not just because the incumbent party lost, but also because of the tax increases that Joe Biden has proposed and the hit to earnings that could happen from those tax increases. But then also what's important this cycle is that the race for control of the U.S. Senate is pretty close. And so that also means that there's a possibility that Joe Biden could win the presidency, but that the Republicans would maintain control of the Senate. And we actually think that that's a very bullish setup for stocks because you wouldn't have any of the tax increases that would happen under a Democratic sweep, and you could actually get better global relations with Joe Biden in the White House. We think that Biden will still take a very tough line on China, but less so through the route of tariffs and kind of economic warfare, if you might say, and more in a multilateral fashion to try to work with U.S. allies to confront China. As a result, though, we would expect stocks to respond positively in that scenario. The one caveat to that, though, is that Joe Biden could still ban buybacks, and he could still do some financial regulation even without having the same party in control in Congress. So that's a little bit of a risk that we see that's out there. The other piece is that next summer, the U.S. has to raise its debt limit again. And if you remember back to 2011 when we had divided government and we had to raise the U.S. debt ceiling, it was quite a disaster because the Republicans were pushing for more austerity and President Obama was pushing to raise the debt limit. So we could see a similar fight this time, and that could have an impact on the market.
If Trump were to win the re-election, we expect that the Senate is going to remain in Republican control. And so Trump's priorities for a second term would include the following. So first, he's going to focus on additional tax cuts and tax reform. So before COVID-19 hit, Trump was focused on trying to build out a tax reform package that was going to simplify the tax code, just have two income tax rates, cut those rates down for middle-class Americans. He's also calling for a payroll tax cut, so that would help workers. And then he's also talked about indexing capital gains taxes to inflation. And that has actually come up again more recently as something that he's been looking at again, particularly as Joe Biden has been calling for increasing rates on capital gains taxes. And so he also wants to make some of the individual tax changes that he enacted as part of the 2017 tax reform permanent going forward. Second big thing was that he's going to focus on more deregulation. And this would be with regard to the energy sector, finance sector, and the transports as well, especially because he can do all of this without Congress. So if you still have a divided government, it still allows him to move forward on deregulation, even without having Congress by his side. Third would be he wants to focus on higher defense spending. Fourth, he wants to continue to take this strong line against China on not just trade anymore, but also on national security issues. So while his first term was more focused on trade and tariffs, now he's focused on investment in China and removing US capital from China. And he's also trying to focus on protecting critical technologies, things like 5G and other national security concerns. He's also expected to take a tough stance with regard to Europe in regards to trade. And he also wants to do infrastructure. This is something that he said that he wanted to do in his first term. He's now said that it's going to be a priority for him next year if he can get it done. And we expect that he would probably push the Republicans who would normally be against this for deficit reasons to actually get it done. The other issue that could come up is that we are going to have a case in the US Supreme Court the week after the election on the Affordable Care Act, which is the Obama era healthcare bill. And so the case is going to basically center on the fact that Trump got rid of the penalty for the individual mandate that requires people to have health insurance. And the question is, if you do that, does now the entire law have to be shut down, or can it be severed from the law and allow the law to continue? So that decision may require the Trump administration to actually have to work on a healthcare proposal, but that'll all depend on what that decision will actually be coming out of the Supreme Court. Mm-hmm. For Vice President Biden, we think that his advisors are thinking about whether or not he wants to do a fiscal stimulus package of just maybe $1 trillion in the beginning of the year that would not actually have any tax increases attached to it. And that might be more likely if we don't actually see any fiscal stimulus coming out of Congress this fall before January. The other option that he could do is an even larger fiscal stimulus package in, say, the spring, which might be something along the lines of $3 trillion, and that would include tax increases. So that package would be kind of comprehensive. So what he would try to do is do traditional infrastructure investments, so focusing on things like highways and bridges and rail and 5G, then also trying to do some green energy or green infrastructure initiatives. So he's going to focus on supporting renewable energy, electric vehicles, and improving energy efficiency. There also could be some more healthcare spending. So we think he's going to try to support the federal healthcare subsidies for the Affordable Care Act and also the Medicaid program, which is the low-income healthcare program. He also might do some things on community policing, on race relations, and all of that would be coupled with higher taxes on corporations and high-income individuals. And Biden is saying that he wants to raise taxes, not just to raise money for his policy initiatives, but also as a matter of fairness to make sure that corporations and high-income individuals, as he puts it, pay their fair share. So we have been of the view that with regard to healthcare, Biden would not pursue a public option, which would basically compete with private health insurers, and that we instead be focused on shoring up the Affordable Care Act and Medicaid programs. And all of that would mean, especially because if we might have high unemployment that's going to continue into January, and if you're still dealing with the coronavirus pandemic, it'd be easier for him to kind of foster additional healthcare spending for individuals. And all of that is going to benefit things like managed care companies, Medicaid HMOs, hospitals, and healthcare equipment stocks. He also may have to make changes to the Affordable Care Act, just depending on what actually happens with that Supreme Court case.
Right. So Jeanette, if you were to, sitting back from your position in the conversations you're having, at this point, how is your team handicapping this election?
So we're looking at a couple of different things, and I can actually switch ahead to that if you like. So we're looking at two different things. So one is that, Joe Biden had been doing better when the coronavirus was increasing in the US, and Trump was doing worse. And so this is what shows the swing state votes in the election and what their Biden lead has been on July 1st and then on October 13th. And so what we've seen is that originally in July, Biden was doing very well. Coronavirus was kind of out of control in the United States. That started to get better. Trump's numbers have then improved. Now, just because of, a little bit about the debate performance that occurred at the end of September, Trump then being diagnosed with the coronavirus, and things since then, we've actually seen Biden's numbers improve in these states. So overall, Biden has a good lead in the national polls, but of course that doesn't matter since we have an electoral college system. So it's these states that are going to matter. Biden needs to probably win 3 states to pull the election back from Trump. So usually what we say is the Pennsylvania, Michigan, and Wisconsin are those key pieces. But so Biden's lead is up ahead, which is good, but there's other things that we look at too. So we don't look just at polling data. We also try to look at financial market indicators. And so one of the things that we look at is the S&P 500. So this has been a pretty good election predictor for presidential elections. So if the S&P 500 is up in the 3 months ahead of the election, it has indicated that the incumbent party has won. And if it's down, it indicates that the incumbent party is going to lose. And so that has been true 100% of the time since 1984 and 87% of the time since 1928. And so you can see from this chart, this is a chart showing that 3-month period, and currently the S&P 500 is up, which would be an indication that Trump would win. At the same time, the US dollar can also be a pretty good indicator. So this is inverted US dollar chart. So if the dollar is down, it actually indicates that Trump would win re-election or the incumbent. And if it's up, that the opposite party would win. So again, in this case, if you're looking at it, the S&P 500 and the US dollar are indicating that Trump would win the re-election, whereas the polls are indicating something completely different. The other thing that we look at too is we build portfolios of stocks that are actually tied to the election. So we have a Biden portfolio and a Trump portfolio, and we run them against each other. And these are, usually elections don't necessarily matter for the market as a whole, but much more for specific stocks and specific sectors. And what we're seeing within those portfolios is that the sectors or the stocks that would be most impacted by a Biden win or a Trump win, they are showing that Biden would win the election. So this is actually a pretty rare case for what we normally see. Usually if the S&P 500 is showing one direction, those election indicated stocks would be doing the same. But this time we're actually seeing divergent signals. So it's interesting to us. We think there's probably other things at play that are moving the market as a whole. Some of that could be just how much stimulus and liquidity is in the market that you have to be in equities because that's really no other alternative. So some of that could be at play, or it could be signaling that Trump is going to win the election. But right now we're kind of looking at our election baskets that seem to
maybe we could dig into that just for a moment. Can you talk a little bit about those election baskets and what they both look like?
Yeah, so our again, because you think about the priorities I just mentioned, so our Biden portfolio would have a lot of renewable energy names. Our Trump portfolio would have more traditional fossil fuel energy names. Things like companies that would be impacted by fracking or drilling on federal lands, those would be in the Trump portfolio. So if Biden were to put a moratorium or to take away the ability for those companies to actually drill on federal land, then those would be a benefit a disadvantage for the Trump portfolio. The other interesting thing is we also put Exxon into our Democratic portfolio because we actually think that if you're going to have higher energy regulation and you're trying to push this movement towards green energy, it actually could help some of the larger integrated energy companies that would actually benefit from higher commodity prices and less production. So that's one of the interesting things about our Biden portfolio. And then things like I talked about with healthcare. So you have more of these managed care names and the hospitals that would be in our Biden portfolio, where you'd have things like health savings account companies and companies that are doing short-term health plans. Those are in our Trump portfolio. Some financials would be in the Trump portfolio as well. So there's you can kind of see some of the big divergences in energy and healthcare, and things like the interesting thing too is Trump usually, because of the deregulation, one of the stock areas that you're going to see movement the most on this election are kind of these for-profit sectors. So in our Trump portfolio are things like for-profit prisons, which Biden has said that he might try to get rid of immediately upon coming into office, or student loan servicers would be in our Trump portfolio, or things like that. So that kind of gives you an idea of what those two portfolios look like.
Interesting. Now, listen, there's been all kinds of, talking about swing states again, there's been all kinds of controversy around the potential risks or not of mail-in voting. And it's obviously a really split discussion. How might mail-in voting affect the swing states?
Sure. So let me just move ahead to this other, here we go. It's this last slide in here. So mail-in voting is going to be pretty important for this election. Obviously, a lot of states have moved to mail-in voting because of the coronavirus to try to, separate people out of the polling locations and to get people to be able to vote, but in a safe manner. So Trump has been, pretty adamant about decrying the rise in mail-in voting for this election cycle, saying that it could lead to large fraud. And what you've seen is that Democrats have been more likely to actually embrace mail-in voting, whereas many of the Republicans are saying that they're going to actually go vote in person, whether it's on election day or early voting. And so this chart just kind of shows what the impact could be of some of these absentee ballots or mail-in ballots that we would have. So this is just a chart of rejected absentee ballots, and it looks at Wisconsin. So the last bar there just shows you that this is the April primary, just the primary, and there were 23,000 absentee ballots that were rejected. So ballots can be rejected for not having a signature or not being, put together in the right way. Is there an interior envelope? Is there an exterior envelope? Are things signed or things not signed? Things like that. So 23,000 of these ballots were rejected in April, and Trump actually won Wisconsin by less than that amount. So if you actually have a lot of rejections in some of these states, it could be that actually changes the outcome of the race. And so that's why one of the issues that we're concerned about is whether or not we could have this contested election. And so it could be, in states like Wisconsin and Michigan and Pennsylvania, and potentially even several others, that you could be fighting over, were ballots counted that should have been counted or not counted, and all that kind of stuff. And it's going to take them time to actually count some of these ballots.
Right.
So it also means that we may not know who actually won the presidency on November 4th. It could also mean we don't know who is running the Senate, and running the Senate is also going to be important for what kind of changes could actually happen coming out of Washington.
It's interesting. I mean, one of our, core beliefs is that people really hate uncertainty, and markets hate uncertainty. And it seems to me that if there's going to be a transition of power, it may be a relatively close election. What are your thoughts? If there's a transition of power, is it likely to be smooth, or do you think that we could wind up with some unrest?
So I think that there is a risk that things are going to be contested, and just because the level of political rancor in the United States has gotten so high, it could be quite just damaging. It may not necessarily impact the markets as much. I think the markets, so the last time we had a contested election was 2000 with Bush versus Gore. And in that case, you saw the stock market go down up to nearly 10% at one point. But it was also because it wasn't expected. I think what's different this time around is that it actually is expected. So there's a couple of things that could happen. In 2000, the election was ultimately decided around the middle of December. So we could see something similar this time. It may not even take that long. It may just take a week or two for some of these counts to actually come in. But I think the political rhetoric is going to be tough back and forth until then. But then if the worst case scenario is that if we can't come to an agreement figuring out what the result was in each of these states, the bigger risk would be that the election would then get tossed to the House of Representatives to decide who is the president. and that happens in January. And I think that could create a lot of turmoil if that were to come to pass. That's a pretty low possibility, but I think that's one of the things that would be much riskier. But I think at least to some extent, even though it would still be, impactful, I think the fact that people are more, and especially investors, are more attuned to the fact that we could have a contested election. You might not see the market drop as much as you would have seen in 2000. And in 2000, you also had a recession. The US was entering a recession at the same time. So there were other factors at play that were hitting the markets.
Right. Now, you touched on, I want to ask one more question, then maybe we would see if our audience has any questions. We talked a little bit about what may happen if there's no stimulus before the election and the Democrats win. You talked about a smaller package or a larger package. First of all, do you think anything is likely to get done before the election? Because the market really seems to care about stimulus. And if nothing gets done prior to an election and there's a Republican win, what do you think might happen from a stimulus perspective?
It seems pretty unlikely that we would have a stimulus pass before the election. It is possible. So I don't want to say that it's a zero probability, because the Senate is going to try to move a bill next week. So that way they can kind of push the House so that there's actually could be a negotiation. So there's still a possibility that you could get something done. But even the Treasury Secretary came out today and said that he thinks it's pretty unlikely that something would happen before the election. If you do have, let's say, a status quo election, or Trump at least winning the presidency, I think there would be a push to get a stimulus bill done in the lame duck session. So before January, before the new Congress actually comes into effect. So that probably might look something like what they're proposing currently, which would be about $1.5 trillion of stimulus going into the economy. If you get a Joe Biden win coming into next year, I think that's when you would see the much larger fiscal stimulus package, where you're talking about something like several $1 trillion in fiscal stimulus, whether it's $1 trillion at the beginning of the year, or whether it's $3 trillion later in the year, or $4 trillion altogether. So I think you'd see something probably smaller, more likely immediately following the election. Biden would wait until the next year, and it would be larger.
Right. So I want to ask you one more question. I don't have any questions so far open from our audience. Please feel free to type something into the question and answer box. But one of my partner's favorite questions to ask, and he asks every analyst at the beginning of every year, what do you think is something that people think is the most unlikely thing to happen, but in your opinion is possible?
I think in this case, I think the contested election might be the situation that is something that we almost would never think would actually happen. It hasn't happened since 1877. But I think that there is a risk that that's out there. I don't really think it's very likely, but I think that there is a risk that that's out there. I think right now, I think that's the most short-term kind of scenario I could see coming down the pike.
We sure got a surprise in the last election, given what people thought going in. Do you think that there is a possibility that Trump could come through much stronger than people expect?
I do. I think there is an interesting, and I'll flip back to this one slide just to kind of give you an idea of what we're looking at. So this is just the Senate races and some of the key races in here. And so you can kind of look at the margins, which is more important than anything else. And if you're looking at margins of 3 points, 2 points, things like that, that's showing that these races are very close, because usually, the standard of error in some of these polls is usually about 3, maybe 4 percentage points. So this is even showing that just in the Senate, things are very close. And usually what we see is that presidential results in a particular state are pretty tied to Senate results as well. So I think that, again, it seems like Joe Biden has this very good lead, and that may be very true. The polls might be more correct this time than they were last time. We like to look at direction of polls, and right now the direction is widening out towards Biden, which is why we're kind of leaning towards a Biden win. But it also matters, specific states, right? So again, it's not about a national election. If Biden wins Pennsylvania and Wisconsin, but doesn't lose Michigan, Trump has won the race. And so it's also just about these little tiny changes that could matter on the margin. that he could definitely still win the race, and there's that possibility out there. So even if Biden might be ahead by 1 or 2 percentage points, but it's in the standard of error within that state, it doesn't necessarily mean that anything is locked in. We still do have a couple weeks to go. And if you remember back to 2016, one of the things that actually really did put Trump over the edge was that our FBI director, reopened Hillary Clinton's emails, and that was pretty damaging politically. And so if you see something like that happen again, which I think last time it was maybe within a week before the election, that could change the race one way or the other if you saw something like that happen.
So I've got a question from one of the friends of our firm, and he's asking that if Biden were to win, is he likely to retain Jerome Powell? And second, do you think that he would be likely to bring Elizabeth Warren into the fold in some capacity?
So I think that there is a likelihood that Jerome Powell does stay in place. He has been talking about having someone of the ilk of Yellen or Bernanke or Powell. Obviously, Powell's already still there, so that makes that a little bit easier. So I don't think it's out of the realm of possibilities that he keeps him. And right now it's kind of a, at least, and to some extent would give you that steadiness of hand while Biden is dealing with other things. Not that he's like dealing with the Federal Reserve, but I think it might be easy continuity. With regard to Elizabeth Warren, there has been a lot of talk about maybe making her Treasury Secretary or something along those lines. I think that's pretty unlikely. He might be looking at someone like Lael Brainerd actually to be the Treasury Secretary. And I think that if Elizabeth Warren was a member of the administration, there would be that risk that it actually pulls Biden further to the left than he actually probably wants to go. So I think that he would be more cautious about doing something like that. Now, you could also see her potentially, being, the head of the Consumer Financial Protection Bureau or something like that. But the other thing to keep in mind is that, again, just looking at this slide right here, it's going to be probably a very close election. So if, let's say, the Democrats win the Senate, they might win it by just 1 seat. So that's not a lot of room for error. If Elizabeth Warren is taken out of the Senate, the governor of Massachusetts is a Republican, and he would get to appoint the next senator who would fill that space for a period of some time before they could have a special election. So I think it would also be a risk to Biden to lose a Senate seat that he's probably going to need really importantly in 2021.
Right. Interesting. So I have one more question, and it comes from a client of ours in Europe. And he's asking about the fact that it appears that both candidates agree on Trump's stance versus China. And as a policy expert, the question is, do you agree that this is a strategically advantageous thing for the U.S. to do long term? And if you do, what do you think are the key reasons?
So there has definitely been a decided move within Washington, strong bipartisan support to actually start taking a tougher stand on China. And Biden, I think the one thing to think about is that people are saying that Biden might be a lot softer on China. We don't agree with that. We think he might be softer than Trump would be, but we still think he's going to take a hard line on China. One of the things also to think about is that it would be really difficult for Biden to come into office and then lift the tariffs that Trump has imposed on Chinese goods if he's not going to get something else in return. So that makes it a little bit hard for him to kind of ease trade policy too quickly. Obama wanted to work with China because he wanted to achieve his climate change goals. I think there's now an understanding that that did not work. And Biden is generally more hawkish in general towards China than Obama ever was. So we think that there's going to be that renewed continuation. One of the big focuses of either administration is going to be on bringing supply chains back from China, whether it's to the US, whether it's to Vietnam, to India, to Mexico, whatever it might be. I think Trump is going to do that much more quickly. Trump is going to try to decouple the US from China much more quickly. And then I think there's reasons for that on both sides. I think that there has been an understanding of the intellectual property theft that has occurred out of China, the fact that businesses have, had to give up either data centers or by having a lot of their intellectual property housed in China, there's been a lot of theft that way. There's been a lot of theft of companies even within the US when China would send certain employees over who might then steal secrets. So I think that there's an understanding that some of that needs to be reversed, that trade has really impacted manufacturing and a lot of the jobs and industries in the US that used to be beneficial. There's also a concern about, things like rare earth minerals and the fact that China has a pretty almost complete control over that market, and that there needs to be some diversification to protect the US, because I think a lot of policymakers in DC are looking at China as not just trying to look for economic strength, but also military strength, and that they may be also trying to think about national security issues that could arise from a rising China. So I think that in terms of either 5G and making sure that there's some superiority within the US on that, keeping China out of the networks, trying to protect intellectual property, trying to protect national security interests, so that if China could, again, shut down a supply chain very easily with rare earth minerals, with something else, that detriment that could actually have to the US. So I think this is going to be a continued story, and actually the coronavirus pandemic has actually furthered it along.
That's great. Jeanette, thank you so much. I'm just going to make a couple of key points just to wrap up here, if I can get
Absolutely. Thank you for having me.
We really appreciate you taking the time. It's been so interesting. Barometer believes that the market is like a machine, and there's 1,000 moving parts, and there's all kinds of things that impact price movement and what leads and what works and what doesn't. And clearly we are facing up to some big outside influences in COVID. And certainly this election is on everybody's minds, but you can't forget how many structural changes just are taking place all of the time that are strong, but may not be so obvious. And I think that, what's important in our world is having a process that basically takes all those moving parts and synthesizes output to say, what does this all mean when put together? And the way that we sit today, our models would say, in general, we are in a world where investors are more apt to own equities, whether that is that we're in the early stages of reflation, whether that is that the alternatives are not particularly good with 10-year treasury bonds at just over 70 basis points. And certain industries are clearly benefiting. And we've spent a lot of time talking about technology as being a big beneficiary of the structural changes that have been accelerated by COVID. I think it's interesting that some areas of industrials really have gained some strength, and that may be pointing to the fact that all of this stimulus being brought to bear will ultimately have an impact as we get through this COVID pandemic. And so we like to think that our portfolios reflect our thinking and reflect what our models are showing. And, information technology has been the biggest part of our portfolios all year long. We have slowly been reducing our weight there as other groups have picked up the baton. Certainly industrials have become a bigger piece of our portfolios over the last few weeks. Certainly consumer discretionary has been important, has become more important. We've seen, financials be relatively normalized, although our focus has been more in fintech as opposed to banking. And there have been groups that we have been sort of avoiding through the course of the year, like energy, which has become almost a minuscule piece. Amazing to think that energy was close to 20% of the S&P 20 years ago. It's about 3% of the S&P today, so a lot less important, certainly a bigger part of the Canadian market. In real estate has continued to be a pretty small piece because we think it gets hurt if rates go higher, and there's certainly things that are making real estate ownership more difficult, certainly commercial real estate and some industrial real estate as we're going through this pandemic. Now, we will continue to watch for risks. We'll continue to watch for change. We will be very willing to get more defensive if our models were to turn back down. But at this point, just not the case. We're pretty fully invested. And we look forward to getting through this election season, through the October, what can often be a bumpy month. And we hope that we're going to continue to see developments on the science front as it relates to therapeutics and vaccines. But at this point, the moving parts within the market continue to be a little bit more constructive. So thanks very much for joining, everyone. We look forward to doing another call next Wednesday. Thanks for joining us. And certainly if you have any further questions, don't hesitate to give us a call. We're always happy to take these conversations offline. To Jeanette, thank you so much for joining us today. And we'll look forward to talking to you all soon. So thanks so much.